Hello investors and traders, and welcome to the weekly market report. I'm AJ Monte, Chief Technical Analyst with Sticky Trades, and we are launched in our very first week officially, and we have all of you to thank for a very successful start to a very bright future. Now, before I get into the charts, please understand that at the end of this video, I will be going over some of the geopolitical news that many of you have been asking for. So stay tuned to that. And also be sure to hit the like button, the share button, and the subscribe button, because that's going to help us build this new channel. And we have all of you to thank for that as well. So let's take a look at DIA. Looking at the weekly chart, you can see that yesterday we had this big fat bearish engulfing candle. Let me zoom in there a little bit more, because most people don't know how significant that bearish engulfing candle. By definition, a bearish engulfing candle is when the body of the red candle engulfs the previous green candle. But look what happened this week. The body of that red candle has engulfed the previous three green candles. So that's even more significant. Today we have a little bit of a doji there. That's a sign of indecision on lighter volume. That's a sign of weakness as well, with the oscillators going lower. So my downside target is still in place. That target is not hit yet. We are keeping it in place, and that is down at 341.84. In alphabetical order, as we look at IWM, you'll see the same thing from yesterday. We had a bearish engulfing candle that has engulfed the three previous green candles, but a little bit of a wrench was thrown into today's candle with a bullish harami. So what do we do there? Well, when you have a conflict of candles, I talk about this all the time, you use the summation principle. So you can start at the opening all the way at this red candle, and what I'm going to do here is just draw it to the right to show you that that start there is going to be the opening. Right? So we're going to put a line right there. It had gone down to the low from yesterday, so the shadow is going to be at the bottom there. We had a slightly higher high there from yesterday. And where did we close? We closed right at the top of that green candle. So what do we have there? Well, if I take that and draw the lines, we have a hanging man. So that is, again, a refresher on the summation principle and how that works. So again, the downside target still in place, not moving there at 187.62. Let's take a look at the Qs, and I'm going to back out on this one because I want to show the monthly chart on this. The Qs have what looks to be a possible head and shoulders here, maybe even a complex head and shoulders. You have a shoulder here, a second shoulder here, a head right at the top, and if we pivot lower next week, this will be a shoulder. Now, whether or not that forms another shoulder, which defines a complex head and shoulders pattern, we'll have to see. But either way, whether it be a complex head and shoulders or a conventional head and shoulders, the neckline is drawn from these lows. So if we break out next week below the neckline, we could see a move down to hit our target down there on the Qs, which again is 346.73. Now stick with me here before we go to the VIX. I want to show you the monthly chart of the Qs. These are what I call fan lines. These are fan lines. Now, this is the longer term trend. Then the trend accelerated here. We can now draw this fan line from the last touch on the second fan line to draw that out. And then we can take the last touch of that fan line and draw that out. Now, my rules for fan lines are this. When the most extreme fan line is broken, and that extreme fan line has to be greater than 3 fan lines. So here's 1, here's 2, here's 3. This is the 4th fan line. It's the most extreme. When the most extreme fan line in the sequence of fan lines breaks, there's a 90% chance it will go to the next fan line in the sequence. So that would mean a drop to around 300 on the Qs. Now, I know a lot of you think I'm a perpetual bear. I'm not. I'm just reading the charts. That's all I'm doing. Now, I'm going to take that line off because I don't want that to interfere with my weekly market report, but understand where that is and keep an eye on that. Now, if you take a step back on this, this also looks very much like an M-top forming, which if it starts to pull back, that would be an M-top. And guess what? The bottom of the M is down below 300 on the Qs. So we have a lot of downside potential. Understand, our members who follow our publications do periodically take long or bullish positions, but they're very short term in nature. We have longer term bearish positions that we keep in place in the form of diagonal spreads. And this particular pattern on the monthly chart looks very nice for those who have those types of spreads. So keep that M-top in mind as I go to the very last PowerPoint, because I'm going to show you what's happening there. So downside target on the Qs, again, to reiterate right there, let me highlight that for you. That is right there, 367.74. Let's go to the spiders, SPY. You're going to see pretty much the same thing. We have that big fat bearish engulfing that has engulfed the past 3 candles that are all green here. We do have a bullish harami, but if you do the summation principle, you're going to be left with a hanging man as well. And today's candle is a hanging man on slighter volume. That downside target on SPY is 442.49. Now let's talk a little bit about the VIX, and I want to talk about silver as well. So the VIX is still bouncing off of that support level. Why is that support level important? Because if you go back, that's a 3-year low. If I go back even more and look at this on the monthly chart, you're pressing a low here that goes back to 2018. Right, so we have a good long support level that's in place right there. And so that is more bullish than bearish for the VIX, as you might know. When the VIX is on a support level and looks like it's heading higher, that is bearish for the S&P. So we've hit the downside target on that from back here, but now we're waiting for it to hit the upside target, which is up there around 1720. Now let's talk a little bit about silver. As I mentioned last week, I said this area here is the place where I would be a buyer, and I highlighted this right around the moving average, and I was hoping for it to go a little bit lower, but guess what showed up today? A bullish harami. There it is. So there's still a gap below the market, but understand that I bought all of the shares that I had sold out of, and the shares that I sold out of was 15% of my position. I told everyone that I would be a buyer in that area, and hopefully you're following that bullish harami if you're trading silver as well. Now let me give you a little bit of the math. When I sold 5% here, and I sold another 10% up at the highs, what happened is I'm able to buy it back at a lower price now, and I picked up an extra 4% in numbers of shares from what I sold. You see, that's parlaying the position. So I sold up at the high. I gradually scaled out of that, and I told everyone I did not want to go more than 25% out of the position, and I did not. And so the main reason I got back into it is not just because of the bullish harami, but because the dollar is looking weak again, and the dollar is inversely related to SLV. So if it goes back down, that's okay. If it goes up and bumps its head at resistance, that's okay too, because I might do it all over again and parlay the position. So right now, I'm all in with the biggest position I've ever had in SLV, and each time I buy it back, I continue to add to the overall position. And so next time I get in or out, I will let you know. Most likely the next move will be to get out of some. Again, we have to wait for the signals and see where that goes. So let's go to some of the geopolitical news. Well, this isn't geopolitical, but it is news, and you may have read about us on Yahoo Finance. The launch is in. We have officially launched, and our Mascot Sticky, the Australian Shepherd, is a star already. We have a lot of dog lovers out there, and I thank you for the comments on YouTube and also on Twitter. So follow me on Twitter, Facebook, YouTube especially. And again, make sure you hit the like, share, and subscribe button. Now remember what I showed you with the Qs. This is what an M-top looks like. Now we are right at the second top. We haven't pivoted from that yet. But if we do, you can count on a high probability chance that we will at least move back down to the neckline. Whether we break out below that neckline is to be seen, but that's the pattern recognition that I want to show you. And again, I give credit to those who made this, and that is dailypriceaction.com. So I grabbed that from Google Images, and again, I want to make sure we give them credit for that. All right, next slide here. If you look what's happening with the craziness in the market, right? Meta published this in that they have a 50% drop in the initial users to Threads, which is not good news, right? You get a 50% drop, that's telling you that you don't have any stickiness there, and then that could ultimately hurt the long-term growth of this new Thread program that they have that's competing against Twitter. But that bad news resulted in what? Well, the stock went up. Isn't that crazy? The bad news comes out, this stock goes up, it's a mega cap stock. And if you think that's crazy, look what happened here with Goldman Sachs. Goldman Sachs profits plunged 58%. 58%. And the stock goes up. Now, it's at a resistance point. I'm not telling you to buy it or sell it here. I'm just showing you the craziness and what's happening in the market. And as I talked about many months ago, I was talking about the Fed Now program with regard to CBDC. Well, as everyone is talking about how the Fed is pushing us to a digital currency, the Fed is on defense right now, and this came from their Twitter feed. Is the Fed Now service replacing cash? See, they don't want that to be taken as the Fed is trying to push us to the digital currency. So they're doing a little damage control. The question that I am going to ask you is, do you believe the Fed? I don't believe anything that's coming out of the Fed. That's my personal view. That's totally up to you what your views are, but I don't believe anything. And as they push out the Fed Now program, you're going to see a very strong push, especially out of the World Economic Forum. They're all colluding here to get the world on a digital currency, and we'll see how that evolves. Now, U.S. indicators are pointing to a recession starting soon. And while I've been talking about that for a long time, the market seems to be ignoring every bit of this. Now, this came out through Sean. I'm going to give Sean a shout out there for pointing this article out to me in Reuters. I figured I'd grab that and show everyone this today. And again, shout out to Sean. Thank you very much for following us. So look at what's happening here with the debt to income ratio for home buyers. Now, remember, as the Fed increases rates, what happens to the cost of owning a home? Well, there's a lot of people out there that are in variable mortgages, whereas the interest rates go up. Well, guess what? Their mortgage payment goes up, and their income is staying where it is. And in some instances, it's dropping. This is not a bullish thing for the economy, believe me. So keep an eye on these statistics as they continue to come out, because the debt-to-income ratio is storming higher. And you could see what happened back in the housing bubble before the crash of 2008. That's where we were, and we're much higher than that right now. I wanted to point this one out to you. The inverted yield curve. For those of you that are not familiar with this, because not everyone is paying attention to the bond market, you have to know that an inverted yield curve indicates that we're heading to a recession. Since 1955, this has never been wrong. So that tells us that within 6 to 24 months, after the inversion, we generally go into a recession. Well, guess what? It started inverting in mid-2022. So we're already over a year into this inversion, and it's getting worse by the week. So what does that mean? It means we're heading to a recession if you're following the historic indicators here. This is a leading indicator to an economic recession, and that's how we look at that. Thank you so much again for following us over here at stickytrades.com. We have a lot of exciting news coming down the pipeline, and one of which is our AI involvement. We are going to be taking my 7-point trading checklist and incorporating that into the bots and giving you a higher probability outcome. That's our goal, of course, no guarantees, as you may imagine. But if our percentage of accuracy is high now for individual stocks, imagine what's going to happen when we throw AI into it. For those of you who are on our Wednesday rapid fire session, you know exactly what I'm talking about with regard to the percentage of accuracy on individual stocks. So thank you so much for joining us. We'll see you on the next report, and you have a good weekend. So long.